So I want to talk a little bit about the correlation between gold and stocks, and particularly how that will help us being able to possibly better time, for the lack of a better term, either stocks or gold. There are two things we're going to talk about right now. Number one is correlation. The other key term is extremities. So correlation and extremities are the two terms we're going to focus on. I think particularly now as we continue to be very late in the economic expansion cycle, and at least in my opinion, gold continues to be something that I think has plenty of upside here. Not a gold bug here, so don't worry about that. I want to be very open-minded as to the outcomes. But that's my current posturing, and what I've noticed over the past few weeks, probably even the past few couple of quarters, a lot more people are trying to gauge what to do with gold based on what the stock market is doing. And I can understand the reasoning for that. It's unfortunately an oversimplification. But the general thinking is, and you may want to comment down below if you've heard this before, or maybe agree or disagree, but a common sort of interpretation is that if stocks go up, then the price of gold will go down, and vice versa. Basically, people think that gold is something that's just, kind of like an insurance policy, so to speak, that, people buy it if stocks go down. It's not that simple. There is something to that, but it's definitely not that simple. So we'll talk a little bit about correlation, and we're going to flip to the chart here right now. So the first chart, actually it's the only chart I want to show you, but what I did here is I took the S&P 500 to represent the stocks, which is the golden or yellow line you can see, and the blue line is gold. In fact, I should have probably reversed this, but again, gold or the GLD ETF is blue. The price of the S&P is in yellow, and you can see that even though there is definitely plenty of correlation breaks, and this chart only looks back about 2 years. You can see inverse correlations here where stocks go higher and gold goes lower. But broadly speaking, at least last year, there's a fairly positive correlation, at least if you look at it through the lens of 12 months. There are correlation breaks, certainly. And then there are periods, like, for example, the past few weeks, where we've seen a completely positive correlation, right? Both things have gone higher, almost in sync. Yeah. So the point I'm trying to make here is that it is an oversimplification to say that if stocks go up, gold goes lower, and vice versa. But there is a way that I have found that allows us to time this correlation, or gold or stocks, particularly gold is really the point, much better. And that gets us to the second term. Remember, the first term is correlation. The second term is extremities. And for that, I'm going to quickly show you guys something here. We're going to go to our Market Rover platform, and you can see just a couple days ago, our Market Rover, which is this scanner tool that we built, proprietary scan tool for our clients, it started printing these red dots. This is called the Vertical X Pro Overbought indicator. And since then, we've started to see a slowdown. In fact, we've seen gold go lower. So if we now turn this chart into a simple chart, just looking at the price of gold, I'm going to quickly change this now, and we're going to get rid of, there you go. What I have found is that if you want to time, and I say timing is always a difficult thing to say, but if you want to time the price of gold better, the best thing to do is look for extremities. Okay, and extremities are the points and times where the asset, in this case, the price of gold or the GLD ETF, goes basically vertical, right, and becomes very overbought or oversold in the short term. And I think we just had one of those situations occur just a couple days ago. So this is kind of like a current, a pretty timely sort of video, if you will. But if you take that and you take it in conjunction with the stock market, you have an even better timing. So basically what we're looking for, let me quickly flip the camera around. What we're looking for is we're looking for gold to make an extreme move in one direction, and the stock market to either do the opposite or kind of stay flat. So let me kind of give you an example. So if you flip this chart back again, and we're going to go to the price of gold. So you can see recently here, gold had a very extreme move, but if you go back to the upside, but if you go back to the S&P, it has rallied too, but it has had much more of a pause, right? So when you see that correlation in the case of an overbought reading in gold with stocks kind of treading sideways to some extent through a multi-week lens, then you have a better signal to time the price of gold. So again, the two things we talk about is correlation and extremities. And what I can tell you is that I have found the price of gold to be one of the most difficult things to time, particularly because gold can trade very choppy for an extended period of time. But then ultimately it always does make a move in one direction or another. And it always, when it makes that move, for the most part, it reaches an extreme. It doesn't just sell off a little bit when it makes a move or rally a little bit when it makes a move to the upside. It tends to become very overbought or oversold, and that's the points you want to look for. So again, flipping back to the chart of the GLD, perfect example here. Over the past few months, you can see a very strong move to the upside here. Let me get this arrow straight. Then, yes, it went lower, but basically consolidated and did nothing. It got very overbought here. And then it made another sharp move, and now again, very overbought in the near term. So the points in time that you want to focus on is not this stuff in the middle here, but in my opinion, what you want to focus on is, let me take a drawing tool here. You want to focus on these kind of areas, right? And the same thing here. So just want to give you some perspective. I hope this is helpful. If you have any comments or questions, leave them down below, and spread the word on what we do here at The Steady Trader. Talk to you soon.